if you're looking at a $5 million loan, you're looking in a very small market, your odds are stacked against you on getting agency. So much to the point where even if you have somebody who on the team is like well versed in multifamily, years of experience, if they're not experienced in that specific market, they won't count it.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting.
Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my co-host with me, Frank Patalano. How are you doing, Frank?
Good, sir. Ready to talk about money and debt.
Yep. Yeah, we had a good conversation with Julianne Peterson in our last episode. So if you want to find out from the experts, go back and listen to that episode. But Frank and I are going to carry on some of this conversation and deep dive into it just a little bit more because honestly, we could have talked to Julie for hours. In fact, I think Frank and I both have talked with her for probably many hours and just over the years on debt and lending and stuff. So she's a wealth of knowledge, but yeah, let's dive in. Some of this, if you listen to the last episode, might be a little recap of it this time, but we're going to try and deep dive into it a little bit further so that there is a little bit more information. So, because we covered a lot of stuff last time. So, you ready to jump in?
I am ready, sir. I'll start out that I'm not an expert. I do know at one point I had 17 mortgages, but or loans, and I know that the amount of my debt is probably 8 figures. But yeah, I definitely have been around the block, but not an expert.
Amount of my debt is it's approaching 8 figures, I think. So right now, I've had more debt in the past, but I've gotten out of some deals, so that kind of helps with your debt. Now, and this is going to be a topic for maybe today, different day, maybe today, where the debt actually goes against your like debt to income ratio, but we'll talk about that later. So let's first off start with basic loan types, mortgage types for what you would get if you got or were buying a, say, large commercial multifamily property. I mean, even some of these apply to residential, but the terms are different. But let's focus more on commercial multifamily. So I think the biggest loan or the best loan products out there are usually like agency loans. If you'll hear agency loans, like, oh, Frank, what's an agency loan? I keep hearing about it, but what is it? So you want to go?
You asking me? So an
Yeah.
agency loan is basically a government-backed loan in one way or another. The two main types are Fannie Mae and Freddie Mac. I'm not sure if there are others, but those are the two main ones. And it should be interesting right now because with government and politics, I've heard for years they've been talking about maybe spinning those off and not having them be officially government backed. But either way, it's a long-term way to borrow money. It's usually at a slightly better interest rate, but there are also a lot of hurdles.
So the interest rates, if you're, and you can take this with a grain of salt. I don't know the actual percentages, but if you're looking at like going to your normal bank and getting a loan, you might be paying like 6-7% interest. If you're going to agency, you're going to Fannie Mae or Freddie Mac, you're looking at maybe 4.5, 5%. And this right now, this is early 2026. So, I mean, if you were looking at agency debt in 2020, 2021, you were looking at in the 1 to 2%, whereas banks would be in like the 3 and 4s, you know. So I mean, there is a difference. I don't know if it's just like a strict percentage point difference or if it's like half of it or whatever, you know. So generally speaking, though, agency loan is cheaper than bank loans. So
I mean, with that being said, agency loans usually expect you to be a little more stabilized. And
yeah.
they also, they have a few extra requirements on the physical conditions. And I can go into that a little bit because I've had agency loans before.
Let's do go into that because we need to explain what the hurdles are. And right off the bat, you said it needs to be stabilized. So a lot of times you'll hear 90 at 90. And so this means that that property has to be at 90% physically occupied for at least 90 days in a row. So that way
Yep.
you don't just go and get a loan, something that's been sitting half empty for a year, and then the seller's trying to sell it. And so they just pull in people off the street at the last minute to get it up to 90%. It has to be stabilized for at least 90 days. And that's like the bare minimum. The longer, the better. So,
Yeah. Oh, definitely. I mean, just like you said, selling, same thing. If you're trying to get a mortgage and you're saying, oh, we have 100% occupancy, but on the physical side, but that doesn't mean that some people are paying because you just put anybody in. You might have taken it with no first payment, no deposit sometimes.
yep.
And yeah, the real problem will be at day 60. Day
Yeah.
30 will be the first hurdle, and then day 60. So yeah, so other requirements, I mean, they're definitely a decent length term. On the last one we had, I think we had a 7 year. There's 5, there's 7, there's 10. There's even some 12. Usually it's like a 30-year amortization. Mine was a fixed rate, which was great. I think we may have had interest only for a few years. I forget. But at the time when we did it, it was a refi, maybe around 2022. And we ended up getting a rate of 4.0. The coolest story I'll give out of it was that we had to put so much down to begin with. And I forget, I mean, it was a good chunk of money. I mean, I think it was more than 1% of the loan. And basically they said, okay, tomorrow we're going to call you and we're actually going to be down at Wall Street and you have to pick up the phone and we're going to get you the best rate we can get. So they literally called me up and he's like, yeah, I'm the bond trader or the loan trader on, I'm here down in Wall Street. He says, he asked for some of the specifics of it. And he says, what number are you looking for? I said, I'm trying to get to 4%. And he says, I think we can do that. Give me 2 minutes. And he walked out to the floor and then he came back. He says, you're all set. And then he
That's
says,
cool.
you have to close in 72 hours. So
Wow.
yeah, that was pretty fun. And that's what agency is about. And usually the debt service coverage ratio on it, and we've talked about debt service coverage ratios before, it's about 1.25. There is prepayment penalties or yield maintenance, or there's other ways to do it. And usually it's non-recourse. And I know that there are people that talk about, well, all loans are recourse. Yeah, there's still bad boy clauses and everything else in it, but it's a typical boilerplate loan in many ways. And like we said, I mean, you can't just fool around with these numbers. You have to have a good financial statements. You need to have rent rolls. The property has to be in certain condition. On ours, they actually sent someone out to do a property conditions assessment, a PCA, and there was some misunderstandings after we got the loan. The main one was the parking lot, and my partner had misunderstood how much of a parking lot they needed, or driveway and everything else. This is 50 units, and one of the biggest issues was they wanted like $200,000 worth of work done in the parking lot. But at the same point, we had only reserved, and they knew our reserve was $40,000.
Mhm.
So, like I said, there was a massive misunderstanding that actually hurt the deal a lot over time. And then obviously the borrowers, you need at least one person on the team that has experience in something that size. You need to have people who will have the net worth requirements of the loan amount. So, I mean, I was the main sponsor that signed everything on the debt. So, and it worked out. We actually, everybody doubled their money. So it worked out very well. We
So
refied at the right time because within a year and a half later, interest rates went up about 8 times.
yeah. I want to touch on some of the points that you mentioned.
Yeah, yeah.
You mentioned one DSCR. All of this is pretty much market driven.
Yep,
Depending on
definitely.
which market you're in, you might have a DSCR of 1.2, 1.25 that you have to meet. But if you're in a market like mine, you might have to meet a 1.35 to 1.45 that service coverage ratio. And so I'm in a smaller market, and so a lot of times the agency doesn't want to really lend to those. They'd rather lend to the big established markets. And also the size of the loan affects it as well. If you're under $5 million loan, you're like a very small loan to them. They prefer like 10, 15 million and up. um so if you're looking at a $5 million loan, you're looking at a very small market. Your odds are stacked against you on getting agency. So much to the point where even if you have somebody who on the team is like well versed in multifamily, years of experience, if they're not experienced in that specific market, they won't count it. Um,
I would
we
say that it's
face
tightened up a little bit
we've faced
compared
this.
to
We've
2020.
we've had people who invested in DFW, which is 2 hours away from us, and they didn't consider that good enough for the market that we're in. So it's all market driven. I've chased agency debt multiple times, and every single time I've been let down. So my experience with agency debt, both Fannie Mae and Freddie Mac, is not that good. So
Well, I mean, they're definitely looking for better quality housing stock. Uh, they definitely have their favorites on certain markets. The You know where the property was. The property I was in was a very small market too. I would say that conditions have changed a little bit. When we were doing that refi in 2022, basically, if you could breathe onto a mirror, it was a lot easier to get the loan.
yeah, and it also depends on what time of year you're going to be
That's true.
getting the funding. If you're getting your funding, say in the first quarter or first half of the year, you're more likely to get it. From my experience, if you're looking at in the latter half of the year, especially closer to December, your funds are not going to be there. Because a lot of times they've already deployed everything they want to deploy for the year, and so they don't want to do anything else. Or a lot of times they'll say, "Well, we've invested too much in Texas this year, so we're going to pull back." And if you're in Oklahoma, yeah, this would be a good deal, but we have too much funds in Texas. We've heard that before, and so
We definitely have. I mean, on the flip side, I've heard banks say that as well.
yeah, I mean it's frustrating when you hear it when you're going for something. And when you're going for a loan like this, I mean, it takes a couple weeks. You've paid like sometimes 12, 15 grand
Yeah,
to
thousands of dollars.
get the ball rolling. You've already submitted all your paperwork, your personal financial statements, your real estate owned or schedule of real estate owned, all of that to the bank. You've done everything. It takes weeks, and then all of a sudden they just pull the rug out from under you. It's like, okay, well, crap, we're not going to get this loan, so now we have to go do something else. So when you're trying to refi, and this is where we were facing with our latest refi, is we started in June, and we didn't even get anything until January of the following year. So,
So it's definitely slower than some other lenders.
yep, it is
Yeah.
slower. Typical closings I've heard for agency is 60 to 90 days. Um, and if you put that into like your contract or whatever, then you can account for it. But if you put in like a bank or bridge, I've closed with bridge in 28 days from like start to finish. um if you put that into your contract, you might be using your extensions if you need to get to the 90-day mark. So typically I think it's 60, or they shoot for 60, but it can go up to 90.
So back to that, I mean, overall agency is a little less flexible, what you're saying. It's a little more harder to qualify to get it. It's slower, and just borrowing money on the acquisition. This is already past the point where you're doing rehabs and stuff. More
Yeah,
stabilized assets.
I mean they do some like LTC loans,
Yep.
and the interest only for a couple years. Um, But one thing good about agency, yeah, even though they have like big prepayment penalties, is a lot of times the loans are assumable.
Yeah, that's good. For like what,
So
a 1 point fee or something, or what? I forget.
I don't know, but I know a lot of time or a lot of people were buying properties with assumable loans in the last few years because the loans were what at 2% sometimes, whereas if they
Yeah.
went and got a new loan, they'd be sitting at 6, 7, 8%.
I mean, we
So
were looking at deals that were, the main reason why we were looking at them was because of the interest rate on the assumable side.
yeah,
We looked at stuff like I looked at stuff with you outside of your market that was a 3.75%
yeah.
interest rate.
But the bad thing about those, oh, and also we didn't mention your LTV is going to be typically capped at
Lower.
70%, but again, it depends on your market. You might be looking at like 50, 55% LTV. And so that means you have to bring in more capital to close.
Yeah. Um, Especially when you're assuming,
Yeah,
not a
is that
requirement, but when you're assuming they have a certain value and they've been paying it down. So
yeah, so when you're assuming a loan, say the seller has $5 million left on their loan. When you assume it, you're taking that $5 million and putting that into your name. They're not going to be putting more money into it. So you're kept you're lending at 5 million. If you're buying this property for 10 million, then you're going to have to raise the other five. And maybe they bought it for 7, 7.5, and got a loan for 5 million or whatever. And so that's how they were able to get it. So now you're on the hook for coming up with the extra equity. So that's the downside of assuming loans, but the upside is lower interest rates.
so that's agency debt. What other types of debt you want to talk about?
Um, bank debt is pretty good. You want to talk about bank or bridge first?
We can do banks. Yeah, I mean, I've had a number of bank loans over the years. They started giving me a hard time, I think, when I was at 10. The first level they give you a hard time is at 4, and then the real time is at 10. Uh, I had 5 or 6 of them with one bank, so or credit union actually. Uh, I usually have like a 10-year term with like a 20 to 30-year amortization. I know they offer lower terms. Um, it's nice because if you know a lot of people, especially your local branches and your local banks, they'll fight for you.
Yeah.
I've had got
I was gonna say our loans that we have through our local bank is every 3 years they update the rate. Or
yeah, the 3-year resets.
every 5 years they update the rate, but all it does it extends out, so they continue extending it. So I mean it'll go out indefinitely until it's paid off, but the rate changes every 3 to 5 years.
Yeah, and
Other
obviously if you want to go
I was gonna say other times they will actually put like a 10-year term limit on it, so you have to pay everything back by the 10th year,
yeah,
refi
like
or sell or
a
whatever.
hard 10-year. It might still
Yeah,
be a 20 or 30 amortization, but
yeah,
then you have to refi. Now that you say that, it's funny you say that because I have to look at some of my loans. I mean, we have properties that we owe basically 20% of what the original loan was. So,
yeah.
um,
Um, bank. We didn't really get into recourse versus non-recourse. You said basically every loan is recourse, but what that actually means is recourse loans mean that if you default, the bank is coming after you personally versus just selling the property and then washing their hands. So if you owe $5 million on an apartment complex and you can't make the payments, or for some reason you don't make the payments, the bank can come in and sell the property. With a non-recourse loan, if they sell it at 3.5 million, they're going to lose $1.5 million because the loan is for 5 million, they're selling it for 3.5. For recourse, if the loan is 5 million and they sell it for 3.5, they're coming after you for the difference, the 1.5. And so that's one big difference. Um, Theoretically, if it's in your own name, it can count against you in your debt to income ratio for your credit score and stuff like that. But all of our recourse loans don't, I guess, or they're handled differently. I don't even know how they're handled in that regard, but
Well, there's
sometimes,
commercial ones and also personal ones.
yeah.
So would you agree that many times, not all the time, but many times if you're doing a bank loan, it might also be staying inside the bank's portfolio? So can banks sell it off? Yes, but there are a number of banks that hold everything in-house. So
Yeah.
they can work with you better. I like that a lot, especially for local banks.
And then this was always a saying that my dad used to tell me. It's like, if you owe the bank $2 million, and this is like a local bank, a small local bank. If you owe the bank $2 million, that's and you can't make the payments, that's your problem. If you owe the bank 20, $50 million and you can't make the payment, that's their problem.
Yeah, no. I say 1 million and 100 million. If
Well,
you owe a bank $1 million, that's your problem. If you owe a bank $100 million, that's their problem.
yeah,
Stuff like that.
for a local bank, but yeah. So, and
Yeah.
that's why they were limiting you. It's like, all right, you have 10 loans with us. You need to start paying these down, because that was starting to turn into a them problem and not just a you problem. So,
Oh yeah, I mean they banged me out on 4 different reasons why they turned me down, but it's funny because years later they still try to get my business. It's like, guys, I mean they did. They wined and dined me. They took me out to dinner and everything. So we
wow.
ended up going with somebody else only because they had a longer term. The that bank was only willing to go to 20 years. We had another bank that we could squeeze out 25. I mean, 5 more years to make payments. It might hurt you a little bit on the interest side, but it still made the payment a little easier on the payment side. The
Yeah.
principal pay down was lower every month. So yeah, now with bank loans, you're going to do it on smaller deals. You're obviously going to do it on properties that are not like easy cookie cutter like agency approved. I do it all. I have a lot of them on mixed use. I have a lot of them on smaller multis, stuff like that.
And
Um,
that they do a lot of value add ones too, where
yeah, that's true.
you might not qualify for agency. Maybe you're buying a property that's sitting at like 85 to 89%. So we're not quite up to agency, but they'll give you a LTC loan where they're going to cover some of your CapEx costs, and they'll give you, say, interest only for a couple years to get that CapEx done. And so then what they're betting on is you carrying out your business plan and then moving into stabilizing it and then running it as a stabilized property. So that's why they would do it that way. Whereas with agency, they pretty much already expect it to be stabilized at 90%, though they might do a little bit of CapEx. Um, for banks, they'll probably do more for a heavier lift than the agency would. So,
So in the end, I mean, my entire life, my entire business is on relationships. So bank loans are more about relationships.
yeah.
If you have it, I mean, I have one bank that I have 12 different bank accounts with them. Obviously, they want to keep me around. If they can squeeze out a loan from me too, they love it. They want to squeeze me out for new credit cards and everything else all the time.
Yeah.
But if I have a problem, I walk right in, you know, and they take care of it pretty easily.
Yeah.
All right. So what was the third type of loans you
So,
talk about?
so the third main type is bridge loan. Bridge loan is exactly what it sounds like. It's a bridging you from like getting like acquiring the property and bridging you to where you can acquire long-term debt. If it's with agency or bank, typically you go from bridge to agency. And bridge is also, you can use it for like a heavier value add play where you may not be stabilized like you would need to be for agency, and so they'll loan you LTC. They'll give you proceeds for your capex again, similar to like the bank. Now, granted, with bridge loan, one downside of bridge loan is the interest rates are usually significantly higher than other loans, and so that's why, I mean, they're designed that way. They want to help
There's
you
more risk.
get their money quicker and get you out of it and then let you go into something more long term. So
There's more risk with the property. If it was an easy, safer property, the risk would be lower, the interest rate would be lower.
yeah. Um One thing we didn't talk about with bank loans is how long it takes to close. And with banks, you're looking at maybe 45 to 60 days. So a little bit shorter
Yep.
than agency. But with a bridge, like I said, we got a bridge loan and from start to finish was exactly 28 days. So they did it within 30 days. Now, granted, we
Nice.
sort of tried to fast track it, but we were still able to do that. So
I have way too many bridge loans to start. I think because we're buying stuff that's more on the value add side. We're putting in some work and then looking for a longer term debt later.
yeah.
So
So
there's good and bad
so
to it.
so what one thing about bridge loans is, yeah, you can they're typically like 2 to 3 year terms, and then you can get like a 1 year extension or two 1 year extensions. When we got our first bridge loan, our interest rate was 5.99, and agency was sitting at like 2.5. Banks were 3 to 4%. So 5.99 was significantly higher than what we were wanting. But right after we bought it, interest rates started going up. And so when it came time to get out and refinance, everything that we would have refinanced into would have been like 7, 8%. So our 5.99 was then significantly lower than anything else. So it's like, well, it makes 0 sense to refi right now. So that we ended up extending and using all of our extensions because it made sense to do so. But what got us in a pickle was we used up all of our extensions and the interest rates still really haven't come down below the 5.99. So then we had to get out of that good loan.
And
So
agency didn't need us because it was the end of the year.
yeah, it was into the year and small market and a small balance. And so
So what are you usually seeing on interest rates right now for bridge loans?
um I'm seeing 9 to about 12%. It depends on the agency who's doing it. I think our current extension that we're doing during our refi, we're what, 10 and a quarter, 10 and a
I
half,
think so.
something like that.
10 and a quarter.
So, I mean, it is significantly higher, but again, it's designed to be a short term,
Yeah, it's
basically a
not a forever
band
thing.
aid. Yeah.
Yeah. So most of the time they're interest only. Um,
They're non-recourse too. So if you owe them 5
are you
million,
sure they're non-recourse?
yeah,
Well,
bridge
some
loans.
bridge loans are recourse too.
Okay, most of the time I've seen them as non-recourse. Really, the only
Yes.
ones that I've seen as recourse are the bank loans.
There you go.
There are other types of loans out there that may be recourse, especially if you get into like hard money lending and stuff like that. That's
Oh
like
yeah.
all recourse.
So like you said, bridge loans are a lot more for value add. It might be for properties that the occupancy isn't there. Um, there are definitely deals that if you can close faster, it's worth a lot more, and it also entices the seller to choose you.
Yep.
I've definitely had that happen before. Um, but obviously, higher interest rate, shorter term, more expensive, and you have a problem if you can't extend.
Yep. There are some other types of loans out there. Sometimes you hear about them. Most of the time, I mean, there's usually more hurdles you have to go through to get them, and
Or
so,
more expensive.
or they're more expensive. Um, One of those is a CMBS loan or commercial mortgage-backed security loan. You might hear about those. They could be higher leveraged, but they can also go after you if something goes wrong. So
I'm hearing a lot of DSCR loans, and that's just all they're calling it, DSCR loans. I'm not sure if that's falls into one of these categories or not. I think it would. I think it almost falls between bank loans and bridge debt. But
yeah. So when I hear a DSCR loan, and I've heard of it from like our local um, real estate meetup. There's a guy who does quote unquote DSCR loans for single family investments.
yep,
They are giving loans with DSCRs of zero point 0.7 and above. And again, this is one of those for single family. They are anticipating loaning you a bunch of money. You can fix up the property some and either flip it or stabilize it and rent it. Get the DSCR over 1. Otherwise, you're putting money into it and not getting anything out. I honestly, I wouldn't take one of those loans unless I knew everything that was going to happen, and that's where the
Do you have a
underwriting
crystal
comes
ball?
in. It's on my Amazon card. It's on order. So, but that they sound good, but usually when things sound good, they typically aren't so good for you in the long run.
Yeah,
Um,
I mean those are some of the main ones. Those are the top three main ones.
yeah. There's also HUD loans. HUD loans, these can take
Oof.
up to a year to close. They are up to 40 years amortized and 40-year terms, but they have huge prepayment penalties and not always assumable. And so what that means is that is definitely a long-term play. If you plan on holding this property for like generations, that's when a HUD will come in. But if you're trying to do a 7-year apartment syndication, a HUD is not really for you. You really can't buy with a HUD because I don't know of any seller that would want to be on the hook for 12 months waiting for you
Wants to
to
wait
go.
that long.
Yeah.
There are
So
some, by the way. It depends on if you're at the right price. So, for example, the deal that we recently sold, it took us over a year to sell it, but because he was the only one that had the number, we were willing to wait.
okay. So those are the more typical loans types that I've seen. Um and like Julie last in the last episode, she's able to help you find any of those if you need to. So um because that's what the lending broker does is they go through all the different types of loan, bridge, agency, bank, CMBS, HUD, all of the above. So um
And then there's also the wicked expensive stuff,
yep.
almost emergency debt.
Yeah, you can go up to Tony Soprano and ask for a loan, and he'll probably give you one. And you better be paying. Even after you pay, I think you still owe them for for them to watch your property.
So we just had a deal that we needed to close by a certain date, and we were still very short. And yeah, in the end, I was able to get friends to borrow money from them. And when I say friends, I mean they were 12%, just because that's what I offered. And I didn't. Some of them wanted collateral, some of them didn't. But I mean, I had another person that messaged and said, "Yeah, we have a 20% debt fund, and you need collateral." And I'm like, "What?" I thought that was crazy. Most of the time when we're buying real estate, 20% doesn't make sense. It'd be like, Jason, you're an underwriter. If you can find a deal once in a great while, that 20% interest rate, we can still make money. I'll buy every single one of those, Jason. Just remember that.
So typically with those though, that's not long term debt either.
No, I know,
So
but I'm just playing with the concept that
yeah,
if you can break even on a property where you're at 20% interest, then let's buy them all up.
yeah. One thing is for so with bridge, you're looking at maybe a cap of LTV of 70%. Or 70% LTC, so they'll cover your capex. Bank again 70% LTC. Agency, I mean, I've seen anywhere from like 54% up to 63, even though they promised me 70, 75. But what happens when you start getting into these higher LTV LTCs is you start becoming over leveraged, and so then you're putting
Yeah,
everything you're making into just covering your debt, and so
yeah, it's
you're
painful.
you're not making any money. Your investors probably aren't making any money. Everybody, it's a lot of stress for you. So I mean, you have to weigh it. Leverage, it's like it's let you move something
Double-edged
big.
sword.
Yeah, but it also can move you very easily too if things go awry. So just have to keep that in mind.
Yeah, definitely a double-edged sword. We did one deal where we borrowed too much on the refi and everybody got more money back, but then they didn't get almost any other cash flow. because we did not predict the rents. We were probably too aggressive on the rents. So
Yep.
don't get me wrong, everybody got money back early, but then cash flow was terrible after that for a while. And we had equity in it, but it was a cash flow problem.
Yep. So those are the types of loans. If you want to learn more, you can look me up, ironcladunderwriting.com, LinkedIn, YouTube, Facebook, Instagram. Frank, you're on all of the above as well.
I'm around. Yep.
And stay tuned for the next episode of this little mini series where we're going to get into deep dive into what the actual terms are. I mean, we briefly discussed them some, but we'll deep dive into them next. So we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.